Hello, and welcome to another episode of Accounting Recounted. Today, we will be discussing an important aspect of business finance: debt management. Many businesses rely on loans and credit to fuel growth and operations. We've all heard the saying, you have to spend money to make money. And sometimes that money that you need to spend is borrowed in the first place. So, while debt always has this kind of negative connotation, it's not always a bad thing if you're utilizing it properly and staying on top of it and in control of it. I know that this can be very complex and overwhelming, so in this episode, we'll explore common forms of debt and effective strategies for paying it back. So, whether you're a seasoned entrepreneur or starting your business journey, stay tuned for valuable insights into tackling business debt head on. To begin, let's establish a fundamental understanding of business debt. Business debt refers to money borrowed by a company to finance its operations or other financial needs. While debt can be a powerful tool for growth, it's essential to recognize the various forms it can take. So, let's talk about some of those. Businesses can accrue debt in several ways, and here are some common forms. First is what we call short-term debt. Short-term debt typically covers operational expenses like payroll or inventory and is usually repaid within 1 year. Common examples of short-term debt include things like accounts payable, current taxes due, short-term loans, salaries, wages due to employees, and lease payments. And then on the other hand, we have long-term debt, which is used for significant investments such as purchasing equipment or real estate. It's paid back over a more extended period, often several years. This is things like credit lines, bank loans, and bonds with obligations and maturities that are greater than 1 year. So that 1 year mark is kind of the threshold between short-term and long-term debt. And then we have what we call revolving credit, which is a flexible form of credit that allows businesses to borrow and repay funds within a predetermined limit. So credit cards and lines of credit are examples of revolving credit. Then we have term loans, which are it's where you borrow basically a specific amount of money, and that's paid back in fixed installments over a set period. And then last, we have invoice financing, which is a type of debt that involves using unpaid customer invoices as collateral for a loan, which provides a quick source of working capital. Now, let's talk about paying back our debt, right? Which is the key to debt in general. You have to pay it back. So let's explore some effective strategies for paying it back. Managing and ultimately eliminating debt is the key to your long-term financial success in business. The first step in managing business debt is to create a well thought out debt repayment plan. And it should include some of these things. Number one, you always need to prioritize high interest debt. So look at all your loans, see what has the highest interest rate, and try to pay it off first, right? So high interest loans can quickly accumulate, which is why it is so easy for it to get out of control quick. So addressing them promptly is essential. Let's look at an example. So let's say that you have a credit card, a corporate credit card with a 25% APR. Then let's say you have a bank loan that has the 6% interest rate. Well, definitely make all of your minimum payments for both. But if you had to choose between paying off one or the other, definitely pay off that credit card first because it has higher interest and it's going to rack up a lot faster. So getting rid of that one first is obviously the priority. And then you need to take a look at your budget and cash flow analysis. So carefully assess your business's financial situation so that you can understand your monthly cash flow, including income and expenses. This will help you get a clear picture of your finances and will help you to allocate funds to your debt repayment, right? You have to look at your money and see how much you have left to pay off your debt. And then finally, I always recommend setting realistic goals, right? Setting achievable goals is just so important for paying off debt. You need to create a timeline that considers your financial capacity. Remember that sometimes being overly ambitious can lead to financial strain. It's just less likely that you're going to stick with it if you have this super ambitious goal. So it's best to be realistic. Go a little bit easy on yourself and make sure that your goals are actually achievable. That will help you pay off your debt faster. Another strategy to consider to pay off your debt is called debt consolidation. This involves taking out a single loan to pay off multiple debts. Debt consolidation can simplify your debt repayment process and potentially lower your interest rates. However, it is crucial to research and choose a consolidation method that works best for your business. So let's throw out an example. Let's say you have 4 different corporate credit cards, and all of them have different interest rates, different due dates, different balances, and different monthly minimum payments every month. That is a lot to keep up with, and it's just going to be too much to manage. With debt consolidation, you essentially take out a new loan or get a new credit card with a high enough limit or balance to pay off all of your other credit cards. So this gives you one place to go to make payments, one due date to keep up with, etc. So essentially, you're going to get this new card and then you're going to pay off everything else so that you have one place to go to pay everything. Also, just worth mentioning, sometimes credit card companies want you to move your balances to them, so they make transferring your balance from other credit cards pretty easy. And they even offer incentives sometimes too, like a 0% interest rate for a certain period of time or whatever. So that might be just what you need to get a little bit ahead. In addition to the possibility of lower interest rates and smaller monthly payments, debt consolidation can be a way to simplify your life a lot, just because it gives you fewer bills that you have to pay every month with not as many due dates to keep track of, not as many minimum payments you have to keep track of, etc. All right, next let's talk about revenue enhancement and cost reduction. What am I even talking about there? Okay, so what I'm saying is increasing your revenue and reducing your costs can be an effective way to generate additional funds for debt repayment. I know this is so much easier said than done. If we could all just make more money and spend less money, life would be so much easier. But here are a few ways to actually achieve that. For revenue growth, try to explore opportunities to increase your business's revenue, such as expanding your product or service offering, targeting new markets, or enhancing your marketing strategies. And then on the cost reduction side of things, maybe you could identify areas in your budget where you can cut some things out without compromising the quality of your products and services. This might involve renegotiating some contracts with your suppliers, streamlining your operations, or just downright eliminating unnecessary expenses. I feel like there's always somewhere where you can cut just a little bit, and that might be just a little bit that you need to put towards your debt to pay it off. Okay, let's dive into some practical tips that can help you as a business owner navigate the complex terrain of debt more effectively. One of the best ways to avoid accumulating more debt is to establish an emergency fund for your business. Having a financial cushion to help cover you in any unexpected expenses that you might have from resorting to credit when you might not have to. I know everything that I've been saying, I feel like it's easier said than done, right? But these are goals, right? This is not like something you have to do tomorrow. I'm saying set the goal for yourself. Start thinking about it and working towards it. And that means that you'll be heading in the right direction. Next, let's talk about effective communication with your creditors. In times of financial distress, maintaining open and honest communication with your creditors is essential. If your business is struggling to make payments, contact your creditors and explain your situation. I promise you, most creditors are willing to work out a revised payment plan to help you stay afloat. But dropping off the radar and hiding is not the answer, I can promise you that. As someone whose company manages accounts receivable for businesses, it is the most frustrating thing in the entire world to reach out to someone multiple times and there is no response. It's like they dropped off the face of the earth. And I'm telling you that we are so much more likely to work with you if you just communicate. We can't help you if we don't know, right? So go in with that mindset. Let's talk to these people like actual humans and see what they can do for you. They might say no. That's the worst case scenario, but best case scenario, they give you a little bit of a break. Okay, next let's talk about regularly reviewing and adjusting your plan. Businesses evolve and so should your debt repayment plan. Regularly reviewing your financial goals and adjusting them as needed is so important. And I talk about this in a lot of my episodes. If your business experiences rapid growth or unexpected setbacks, be prepared to make necessary changes to your repayment strategy. That's okay, that's normal. Finally, you can explore some debt forgiveness programs. If you're feeling like you're not going to be able to repay things, it might be worth looking into a forgiveness program. In some cases, government or industry specific programs might offer debt relief or forgiveness. Just be sure to research any programs that might apply to your business, especially if you're facing financial hardships. It really just cannot hurt to look. As we wrap up today's episode of Accounting Recounted, it's clear that managing and repaying business debt requires careful planning, disciplined execution, and adaptability, just like most things in finance. Understanding the different forms of debt and implementing effective strategies can lead your business forward to financial stability and success. In closing, please remember that debt is a tool, not an obstacle for your business. When you use it wisely, it can drive growth and opportunity. When it's mismanaged, it can lead to financial stress. So, by creating a debt repayment plan, optimizing your revenue, and keeping an eye on your financial health, you can absolutely navigate the world of business debt. I hope this episode provided valuable insights into the common forms of business debt and ways to pay it back. Thank you for joining me today, and I look forward to sharing more with you in the future. If you have any questions or topics that you'd like me to cover in future episodes, please don't hesitate to reach out to me on socials at @AccountableNumbers or on our website at accountablenumbers.com. Remember, a well-managed debt is a stepping stone to a thriving business. That's it for today on another episode of Accounting Recounted. If you found this information valuable, please subscribe, share, and leave a review. Your feedback helps me continue to bring content that empowers your business's financial journey. Thank you for listening and have a great day.